think that there are signs that this, we could have had the bottom in place for Bitcoin, but I think the next 6 to 12 months are still pretty fraught with risk. Lately we've had a little bit of a risk on uptick within that, but in general we've been on a risk off slant, which makes sense because we have declining PMIs, and so basically we have economic deceleration in most parts of the world, across Europe, across North America, many other markets. We have a strengthening dollar, falling liquidity, and if you map Bitcoin and then the various other projects that ebb and flow because it's all kind of correlated. It tends to follow the PMI cycle pretty closely. And if you want to be even more specific, I would say it slightly front runs PMI because it follows liquidity pretty closely, and liquidity tends to be a little bit ahead of PMI. And so, generally speaking, you see Bitcoin kind of top around the same time that PMI tends to top. And then it usually bottoms a little bit before PMI, but of course we don't have gigantic sample sizes for these observations. We're talking a little bit over a decade of history here. And so the short answer is that from a broad macro perspective, everything in the space is treated like a risk-on asset.
Right.
And so, they're volatile, especially outside of Bitcoin, you're getting into pretty speculative territory. But even Bitcoin, even the maxis might view it as a risk-off kind of counterparty free asset. But just in terms of where liquidity goes, the bigger ecosystem treats it like a risk-on asset, and just for in terms of price. And so I say that's where we are right now. We're kind of obviously in a pretty strong bear market. I think that there are signs that this, we could have had the bottom in place for Bitcoin, but I think the next 6 to 12 months are still pretty fraught with risk until we see a more decisive upturn in things like PMI. And you can also track the same sort of cycle by looking at, say, the copper to gold ratio. If you kind of overlay that on with PMIs, you get the same kind of looking pattern. Basically, once you see these risk-on conditions improve, that should be more of the green light for this asset. But in the meantime, it's I think we're in kind of a pretty tricky market. One way to think about it is that whatever liabilities are denominated in, that's going to be the main risk-off asset, right? Because when you have a risk-off conditions, essentially what you have is asset prices falling relative to liabilities, and so right now that's fiat currency. Globally, specifically, it's the dollar, right? So the majority of global liabilities are denominated in dollars, or at least the most of the biggest plurality of liabilities are denominated in dollars, especially for Western markets. And so that means basically when you have the Fed tightening policy, what they're essentially doing is putting pressure on asset prices relative to everyone's existing liabilities. And so that creates demand for dollars, that creates demand for dollar equivalents, like very short duration T-bills. Normally in non-inflationary environments, that would also create demand for longer duration treasuries. Obviously, that was complicated this time by how inflationary the environment was and other factors. And so in general, in a very practical sense, when you have the incumbent system, which is worth, tens of trillions of dollars in the United States, broad money supply, and then, nearly 100 trillion globally, that our liabilities are denominated in our mortgages, various business loans, government debt. There's all these liabilities denominated in that. That's going to be in practice the risk-off asset. And so if you have the Fed purposely engineering asset price destruction, you're generally seeing everything correlate because you have, say, when you look at why equities are going down, it's not really that their earnings are suffering yet. They started to get a little bit like that in Q2, but essentially, from the beginning of this year, it's not like you had a rapid fall off in earnings from the beginning of the year. Instead, what you had was multiple compression. You had a reduction in equity valuations. And that's the part that tends to be quite correlated with, say, something like Bitcoin, because that basically just represents money flowing out of risk assets and being, as you have the dollar hardening compared to those assets, at least temporarily. The environments where you could have something like Bitcoin decouple from the NASDAQ, in my view, would be a situation where liquidity is fine, but you have earnings deterioration, right? So it could be margin pressures. It could be things like that. That's where generally you'd expect something like gold and Bitcoin to kind of decouple, and you could have Bitcoin treated more like a commodity in that regard. But if you have the opposite, if you have earnings are fine, but you mainly have multiple compression, then it's not surprising to see pretty strong correlation between something like the NASDAQ and something like Bitcoin. The unit of account that many of us are using when we're measuring the price of assets. And so if the dollar is strengthening, at least on a relative basis compared to many other fiat currencies, when you translate things back into dollars, it's a challenging comparison. In addition, it affects global economic growth because, for example, the marginal growth in the world is in emerging markets. That's where the majority of population is. That's where we have less GDP per capita, so it's easier to get the marginal growth from those economies. You generally have better demographics in most of those countries, unless you look at specifically countries like China that are kind of still quasi emerging markets, or at least classified as such. But when you look at traditional emerging markets, like a lot of Latin American countries or a lot of countries in Southeast Asia, you have dollar-denominated debts. That's one of the key differences between a developed market and an emerging market is that an emerging market, there's a decent percentage of its liabilities, either government or corporate or both, that are denominated in currencies that they can't print, that are either dollars or euros, basically foreign hard currencies. And so when they have an environment where those currencies are strengthening rapidly compared to their local currency or compared to whatever currency they're getting their cash flows in, they're getting squeezed on the liability side. It's like if you took out a mortgage in gold or Swiss francs, something that's harder than maybe the dollar at that current time, unless you have a spike in the value of that mortgage, that's not great. And so that's essentially what you see happen to emerging markets every time the dollar strengthens. And it's not necessarily as bad as you expect right now because a lot of the strength we're seeing in the dollar index is specifically its weakness in the euro and the yen, more so than it is, say, super broad-based dollar strength. But there is still a component of dollar strength there as well. And that's, of course, because, you have economic slowdown, so those liabilities matter. And then you have the Fed being more aggressive on tightening, at least compared to the ECB and the BOJ. And so essentially what you have is, corporate earnings globally are being translated, say S&P 500, they're being translated back into fewer dollars when they get reported. And then you also have tightening conditions on emerging markets. And then you also have tightening conditions on, like I said before, U.S. real estate markets, basically anything that's rate sensitive. And so you see this kind of, pull down in a lot of different asset prices. And I think that the dollar is kind of one of the key things to watch. If you see the dollar roll over, pretty clear signs of momentum reversal, that'd be a pretty attractive sign to really kind of push the emerging markets, push things like Bitcoin, push, maybe the commodity trade again, kind of these more risk-on type of conditions. Whereas as long as the dollar's high, and especially if it's high and rising, it's really hard to get kind of sustained rallies in other asset prices when that's happening. Gold can kind of hold its own in that environment, but even gold can suffer in those types of conditions. There are a lot of people in emerging markets, developing countries, frontier countries that want dollars, and it's challenging for them to access dollars. And so if they have currency crises, for example, even if they have dollars deposited at the bank, those are liable to be confiscated and turned into the local currency. There are numerous practical examples of that happening. And so stable coins represent a way for people in those markets to have access to dollars in a way that is challenging for the local banking system, local government to take away from them. And so the issue of stable coins, and I'm talking about the fiat collateralized ones, not the algorithmic ones. But so the fiat collateral, the actual stable coins, they are centralized, but the key issue is that the central hub is outside of their jurisdiction, right? So if you're in Argentina, if you're in Turkey, if you're in a country, if you're in Nigeria, and if you're having problems with your currency in terms of high inflation, and you want dollars, basically those represent these kind of current ability to get dollars. And they're still working out kind of the regulatory issues, like regulation might look a little different 3 years from now than it looks now. But basically those represent these kind of pools of dollars that can be accessed globally. And that has pretty interesting implications because it makes it easier for the world to hold dollars.
By the way, is that bullish for the dollar in your view, this idea that there is now the digital dollar that is available outside the dollar-denominated banking system?
I think around the margins, yes, because so in a world without stablecoins, I'd be a little bit more bearish on the dollar. because we are seeing a shift where I think we're entering a more uh, polar currency world where, especially throughout Eurasia, you're going to see just kind of changing reserve practices, kind of a diversification of payment channels. And I think we're headed that way before the war, and then the war just kind of kicked it up a notch, accelerated that whole thing. So that's been one of my theses. But at the same time, you have a slight offset to that in the sense that the people, regardless of what their central bank's doing, they can go out and buy dollars now. And so basically, you've increased the total addressable market for dollars by, or specifically, you've allowed a larger share of the total addressable market to actually access them in a way that makes sense to them. It's also interesting because it monetizes treasuries. It turns treasuries into a medium of exchange because stablecoins don't just use bank accounts as their holdings. They can also use things like T-bills, and so you actually are effectively using to the extent that some of these are actually used as a medium of exchange in developing countries, you're by proxy, you're basically using a T-bill as a medium of exchange. And so I do think this has implications. It's on the macro scale, it's still a relatively small market. I mean, you're talking over 100 billion, so it's not a small market. It's becoming a meaningful market. But if that becomes many hundreds of billions of dollars or $1 trillion, that obviously has pretty strong implications for the dollar. And I think we're in an environment where, I mean, like an Argentinian explained it to me. He's like, if I want currency for the next month, I hold it in local currency. If I want some savings for the next several months or a year or more, I'll use some stable coins. And if I want super long-term savings, I'll put some into Bitcoin, which is obviously more volatile and has more appreciation potential. And I think that's kind of the environment that we're in for a period of time, subject to what happens with regulators. Because, like I said before, those stablecoin providers are, um, you know, centralized, and they're therefore subject to regulations. They can blacklist accounts. They basically have to comply, with the major powers, international laws.